You've poured your blood, your sweat, probably a few tears, and a whole lot of money into building your business, right? It's not just a company, it's a huge part of your life's work. But have you ever stopped to ask, what happens to it all when you're not around? Today, we are digging into that exact question. We're talking about business succession planning, which is really just a guide to making sure your legacy is protected and not just left up to chance.
All right, let's just dive right in. We're going to start with what is probably the most important and, let's be honest, the most uncomfortable question any business owner can possibly ask themselves. No, really. Just take a second and think about it. If the unthinkable happened tomorrow, is there a clear step-by-step plan in place, or would it just be chaos? Planning for this moment is one of the most critical financial decisions you will ever make.
Because, look, without a plan, things get chaotic, and I mean fast. We're talking immediate financial instability. Ownership could pass to a spouse or a child who has zero experience and maybe zero interest in running the business. Your surviving partners, they could be forced into really tough negotiations with your family. Banks could suddenly call in loans. You could even be looking at a forced liquidation, a fire sale. It is an absolute recipe for destroying relationships and wrecking the very business you worked so hard to build.
And this right here, this gets to the absolute heart of the problem. Your business isn't like a share of Apple stock you can just sell in a few seconds on an app. It's a complex, private asset. There's no easy public market to figure out its value or to transfer ownership. And that's exactly why all that chaos we just talked about is the default outcome. So, how do you avoid that disaster? How do you create predictability? Well, you need what I like to call a business prenup. It's a fantastic way to think about the single most powerful tool you've got. Okay, so this prenup is officially called a buy-sell agreement. And all it is really is a legally binding contract that you and your partners create before it's ever needed. It lays out the rules of the road. It defines exactly how ownership is going to be transferred, at what price, and under what specific conditions. It's the rulebook that brings order to a situation that would otherwise be complete chaos. And you know, this isn't just about death. A solid buy-sell agreement can be triggered by a whole bunch of life events. A serious disability, retirement, even personal things like a partner's bankruptcy or a messy divorce. It protects all the owners from a huge range of what-ifs. Now listen up, because this is maybe the most crucial point of all. Having the legal document is only half the battle. If you've got the rules but you don't have the money to actually execute the plan, well, you don't really have a solution, do you? It's like having a perfect map but absolutely no gas in the car. So that brings us to the next logical step, right? How do you put the financial muscle behind this agreement to make damn sure it actually works when you need it most? The most common and frankly the most effective answer is buy-sell life insurance. It's designed for this exact purpose. When an owner passes away, the policy pays out a tax-free death benefit. That cash then goes to the surviving owners or to the business itself, and they use it to buy the deceased owner's shares from their family. It ensures a smooth, fair, and pretty much immediate transfer of ownership. No drama, no delays. Now, there are two main ways you can set this up. With a cross-purchase plan, each partner owns a life insurance policy on the other partners. This is super simple if it's just 2 or 3 of you. With an entity purchase plan, the business itself owns one policy on each owner, which is a lot cleaner and easier to manage if you have, say, 5 or 6 partners. Each way has different tax implications, so it's absolutely key to work with a professional to figure out which one is the right fit for your specific situation. But a really complete plan, it goes beyond just the buy-sell agreement itself. There are other critical risks out there that are just as important to think about. Everybody worries about death, but here's a pretty startling fact. You are far more likely to become disabled during your working years than you are to die prematurely. And a disability, it can be even more disruptive to a business. It creates all this tension and financial strain if a partner can't contribute anymore, but, still needs to draw an income. And this is exactly where disability buyout insurance comes into the picture. It works just like the life insurance version we talked about, but it pays out while the disabled owner is still alive. This gives the business the cash to buy out their shares, it provides that partner with fair compensation, and it lets everybody move forward without all the stress and uncertainty. It's also so important to understand this difference. People get these confused all the time. Key person insurance protects the business. It gives the company cash to survive the loss of a vital employee, to cover lost revenue or the cost of finding and training a replacement. Buy-sell insurance, on the other hand, protects the owners. Its only job is to fund the ownership transfer. 2 different tools for 2 very different but equally important jobs.
Of course, none of this works unless you all agree on a price. And let's be real, this is often the trickiest part of the whole conversation. You could agree on a simple fixed price, which is great for its clarity, but can get outdated super fast. Or you could use a formula, like a multiple of your earnings. Some businesses just decide to get a professional appraisal done whenever something happens. You know what? The most important thing isn't which method you choose, it's that you all agree on it up front to stop any fights from happening down the road.
So I know this might feel like a lot, but it's actually a very manageable process when you break it down. So let's do that right now. Let's build a clear, actionable roadmap to protect your legacy. All right, here it is, your 5-step roadmap. It's that simple. First, you're going to work with an attorney to draft an agreement that is customized for your business. Second, you'll agree on that valuation method we just covered. Third, you fund the agreement, probably with the right kind of insurance. Fourth, you should really consider adding that key person coverage to protect the business itself. And finally, number 5, and this is so critical, you have to review and update this plan every single year. Your business changes, right? So your plan has to change with it. And as you follow that plan, just try to avoid these common traps. Don't assume a standard shareholder agreement has you covered. It usually doesn't. Don't wait until you're ready to retire. And please, please do not use a generic template you find online. Your legacy is worth a professional, tailored approach. When it comes right down to it, the choice is really this stark. There is no middle ground. The future of your business will either be a smooth, predictable transition because you made a plan, or it's going to be a future defined by conflict and stress. So, the last question is for you. The legacy that you have worked so hard to build, it's going to be remembered for its thoughtful continuation or for the chaos that came after. The choice is yours to make, and the time to make it is right now.